Big tech will spend more on AI this year than most countries spend on defense. Facilities like this one cost billions of dollars to build, and there's a frenzy right now to build as many of these as possible. But here's the problem. No one actually knows if enough revenue will ever be generated to pay off these massive investments. Why are big tech CEOs betting the future of their companies on these AI factories? And is AI a bubble that's about to burst? We're going to dive into that today, and we'll talk about the implications for your stock investing portfolios. Let's dive right in.
Your portfolio might look diversified to you, but in reality, if you own index funds, nearly 1 in 3 of those dollars is riding on the AI revolution. The Magnificent 7 stocks, Apple, Amazon, Google, Meta, Microsoft, NVDA, and Tesla, now make up a record 32% of the S&P 500's market value. So 7 stocks out of a 500 stock index have almost a third of the total value. Now, has the S&P 500 index ever been this concentrated? No. The top 10 stocks in the S&P 500 have their highest weight ever in the index. And stocks now make up almost half of all household financial assets in the US, which is also the highest on record. And households now have more wealth in stocks than they do in real estate, believe it or not. So you've got a small handful of stocks that comprise a greater share of household wealth than ever before. Oh, and by the way, did I mention that the price to earnings multiples on the Mag 7 stocks are almost 50% higher than the rest of the index, sitting at 31 times forward earnings estimates versus just 21 times for the rest of the index? What could go wrong here, right? So that's why we care if AI is in a bubble, because if it is and it bursts, a brutal multi-year bear market could impact a lot of people. Now, I will point out, these are some of the best businesses in the world with large user bases, strong moats, high profit margins, and consistently high growth rates. In fact, in the last 12 months, the Mag 7 has delivered earnings growth of more than 20% versus just 8% for the remaining 493 companies in the S&P 500. And analysts estimate the Mag 7 will grow earnings another 15% over the next year. So if the Mag 7 can hit those estimates, it'll be yet another strong year in which investors can defend these premium valuations and high portfolio weightings. But I'm here to tell you that the composition of these megatech businesses is quickly changing, and it's changing because of profound bets on AI and data centers. Now, ChatGPT was launched 3 years ago in November 2022. Since then, the annual capital expenditures, aka CapEx, made by just 4 companies, Amazon, Google, Meta, and Microsoft, that's up $200 billion annually. Yeah, that's right. In aggregate, those 4 were spending $150 billion per year on long-term assets before ChatGPT came along, and this year they'll spend around $350 billion. And why do I single out those 4 companies? Well, within the Mag 7, they're pretty much responsible for the vast majority of CapEx spent and most of the spend increase over the past 3 years. 3 of those 4, of course, run the cloud computing businesses, and the 4th, Meta, well, they're committed to bold bets on the future. All 4 see AI as the most important technology shift of our lifetimes. Now, in contrast, Apple, NVIDIA, and Tesla's CapEx outlays, as you can see here, are much smaller. The increase in AI investment by the big 4 tech giants, let's call them the CapEx cartel, is frankly pretty shocking. They've more than doubled CapEx in 2 years, and analysts think they could spend as much as $500 billion in 2026. That's an insane amount of money. And where's that money going? Well, clearly a significant chunk flows to NVIDIA, which has seen revenues rise by $140 billion annually since the launch of ChatGPT. And that's driven NVIDIA stock to a world-leading market cap over $4 trillion. Now, NVIDIA's GPU-based server systems, of course, are the key ingredient powering the AI model training and model usage, often referred to as inferencing. And these systems account for as much as 50% of the upfront cost of a new data center focused on AI. The CapEx cartel spending also goes towards other components of AI data centers as well, including land, the building shells, the power transmission infrastructures, cooling systems, wiring, networking, etc. You can kind of see how the spending categories break down in the notes to the financial statements of the big tech giants. I posted one here as an example, and we're going to dive into a financial model of an AI data center later in the video. But these AI data centers are seen as critical assets to the CapEx cartel. And in 2025, demand for building new data centers has exploded, with new builds getting unfathomably large. We're talking land areas greater than 500 football fields in size, power requirements that rival mid-sized cities with like 500,000 homes. So Amazon's out there building gigawatt-scale data centers in multiple states like Indiana, Pennsylvania, North Carolina. Meta is building Prometheus, a 1.3 gigawatt mega data center in Wyoming, and another mega multi-gigawatt data center in Louisiana called Hyperion that could one day end up being one of the largest man-made structures on planet Earth. Microsoft, for their part, is building the Fairwater gigawatt data center in Wisconsin, and as a tech partner in the Stargate project, which is the largest AI infrastructure project in history, it aims to spend hundreds of billions of dollars over the next 5 years. This kind of feels like a arms race out of a sci-fi movie or something. Now, you might be asking, how's the CapEx cartel funding these mega AI projects? So let's talk about that. The CapEx cartel has collectively generated about $500 billion of cash flow in just the past 12 months. And that annual cash gusher, it's still growing about 20% on a year-over-year basis. Since 2022 alone, the CapEx cartel has added $250 billion of annual operating cash flow. And where does it come from? Well, under the hood, you got a collection of some of the best businesses in the world here. Amazon's retail business, AWS, Google Search, YouTube, Google Cloud, Facebook, Instagram, Azure, Microsoft 360, Xbox, LinkedIn, Windows, Activision. Woo! In other words, these are amazing cash flow machines. However, it's also true that the growing data center investments are eating up a larger and larger share of this cash flow. This year, CapEx will consume roughly 65% of the CapEx cartel's operating cash flow, which is up from 40% in 2023, and that just means it leaves less free cash flow that can be distributed to shareholders via buybacks or dividends. Now, the rise in data center CapEx also has a cost on the income statement as well in the form of increasing depreciation expense, and it's this higher depreciation expense that will make it tougher to grow earnings in the quarters ahead. In the next 1 to 2 years, I suspect we could see some profit margin deterioration in a few of these companies, and investors could start to aggressively question the CEOs about their dwindling free cash flow. In fact, we saw this happen in 2022 with Meta and a couple of the other large tech companies after their post-COVID hiring binges put a big dent in profits. Now, back then, they were able to course correct quickly with reductions in the workforce and efficiency initiatives, but this time adjustments could be a little bit slower given the fixed cost nature of the data centers if they need to pull back. Of course, if the CapEx cartel can generate a lot of new revenue from these data centers, then it's all really a moot point because cash flows and earnings will continue to go up. We'll talk about AI revenue projections in just a few minutes, but one myth I wanted to dispel before we move on is the myth that these large tech companies are suddenly in some dire financial position. Permabear account Zero Hedge recently implied that tech companies have no more free cash flow, which just isn't accurate if you look at the numbers. Other accounts sounded the alarm on Meta's cash balance on the balance sheet. If you look at Meta's most recent balance sheet from Q3, you'll see that, cash balance has gone down, but they also have $34 billion of short-term marketable securities, which are basically short-term bonds and money market funds that can easily be converted into cash at a moment's notice. The reason the cash line specifically went down recently is in large part due to its investment in Scale AI, as well as significant share buybacks. If you look at the cash flow statement, you'll see that Meta generated $80 billion of cash flow from operations just in the first 9 months of 2025, and that's up 26% versus the prior year. You'll also see they spent $48 billion on CapEx, that's a lot, $15 billion for Scale AI, and the $26 billion on share repurchases. But CapEx was more than covered by cash flow so far this year. And frankly, a business that's on pace to generate over $100 billion of operating cash flow has a lot of capacity to invest. So that's exactly what Meta's doing. Will the investments pay off? We don't know, but they've got the financial firepower to support it. Now, another recent criticism is that Meta is raising debt now to help build its data centers. And it's not really a mystery why they'd start bringing in funding partners like Blue Owl Capital for these massive data center projects, frankly, because for one, using debt to finance part of the land purchase or infrastructure build kind of can make financial sense. Like you might get a mortgage on a home purchase, for instance. It's the same idea, but on a larger gigawatt data center. And second, bringing in other financing partners who can share in the cost and benefit of the mega project, well, that reduces Meta's capital requirements, mitigates some risks. So Meta's CFO, Susan Li, mentioned that on a recent earnings call. I will point out that Meta does have the highest rate of CapEx growth in all of the CapEx cartel, maybe all of the world, but for now, they've got the financial firepower to support it, so let's move on. So far, I've just focused on the publicly traded mega caps, specifically the 4 I've been calling the CapEx cartel. Now, those titans have the growing cash flows to help them fund their own AI bets, and even if the bets don't work out, they're unlikely to cause major financial distress. However, it may not be true of every player that has been sucked into the AI boom, which includes utilities, manufacturers, private companies like OpenAI, xAI, and new infrastructure players such as Nebius and CoreWeave, which are often referred to as Neoclouds. The Neoclouds are aggressively buying GPUs and building AI data centers, pretty much in competition with the big tech cloud providers, yet the big tech firms are also significant customers of Neoclouds. It's confusing. Why is that? Because demand for AI compute still vastly exceeds today's available supply, so Neoclouds are playing a key role in providing some extra supply to big tech and also AI startups that need the compute. Neoclouds also give us a clean way to see the economics of owning and renting GPUs right now because the largest Neocloud, CoreWeave, went public in March of 2025, so we get the benefit of seeing their financials. And in CoreWeave's most recent quarterly results in Q3 2025, they showed quarterly revenue of $1.4 billion, gross margin 73%, and adjusted operating margins of 16% on about 500 megawatts or half a gigawatt of active data center capacity. Those are pretty solid operating profit margins, and it implies an annual revenue potential of about $10 to $12 billion per each gigawatt of data center in operation. CoreWeave, by the way, has a revenue backlog of more than $50 billion, and they expect to deliver that over the next decade as they build out several gigawatts of new data center capacity. Meanwhile, Nebius, another Neocloud that went public this year, they recently made headlines by signing a deal with Microsoft to supply AI compute worth as much as $17 billion over the next 5 years. These numbers are crazy, right? Nebius is still in the early stages of building out their initial capacity. So there's other Neoclouds scaling out as well, including companies like Lambda and Crusoe Energy. But one key risk I see with Neoclouds is that as the CapEx cartel's own facilities come online, the Neoclouds, well, they could become the first to see cuts to usage when there's too much supply of compute. Then there's Oracle, the old enterprise software and database company turned cloud computing powerhouse. Even though Oracle was late to the game behind AWS, Google Cloud, Azure, the company's been aggressively pursuing AI data center capacity since about 2024. Oracle is now one of the main players building out the multi-gigawatt Stargate data centers. And I showed you that earlier, but Oracle's ambitions have paid off massively in 2025 as their revenue backlog has surged to like crazy levels. In September, Oracle's stock surged 40% when they announced the backlog had risen from $140 billion to $455 billion in just one quarter. Now, that was due to several multi-billion-dollar contracts signed in the quarter, as well as a mega contract signed with OpenAI. And the Wall Street Journal reported that the OpenAI contract was worth $300 billion and would add $30 billion of annual revenue to Oracle each year. There's just one problem. OpenAI doesn't have that much capital. The maker of ChatGPT has been raising fresh funds every few months to cover its current cash burn since it's at least several years away from being profitable by their own admission. Yet that hasn't stopped OpenAI from committing to massive multi-billion-dollar deals with NVIDIA, AMD, CoreWeave, Oracle, and others. And NVIDIA invested in OpenAI recently, which some see as proof that OpenAI has a clear path to make good on its contracts, while skeptics see it as a circular deal that allows NVIDIA to basically pay for their own GPUs. For now, let's just say OpenAI's funding and commitments are a key risk to the AI boom. But back to Oracle. Tech publication The Information dropped a report claiming that Oracle makes a tiny gross margin, under 20%, from renting their GPUs. And that had people screaming that AI is an unprofitable bubble. The problem, though, with the Information's report is that Oracle's still scaling up their GPU cloud business. It's like saying a restaurant isn't profitable before they've even opened their doors to the public. And at Oracle's recent Investor Day, they called out a 35% contribution margin target on their AI infrastructure. We'll have a lot better idea of Oracle's actual data center economics probably in a few quarters. Now, so far, we've talked about the CapEx cartel, Neoclouds, Oracle, which are all rapidly building out data center capacity, but there's also others doing it as well. You've got Elon Musk's xAI startup, which built one of the largest AI data centers ever in 2024 called Colossus. And xAI just raised another $20 billion to build out Colossus 2. Colossus 1 was several hundred megawatts in size, with several 100,000 GPUs deployed, and Colossus 2 will be multiples of that size. Then in China, you've got major tech companies like Alibaba, which have committed to building out tens of billions worth of AI infrastructure as well. And looking beyond tech companies, now there are sovereign nations like Saudi Arabia, country blocs like the EU, universities like UT Austin, they're all planning to build out massive AI infrastructure. Do you see the potential problem here? With so many players building out capacity all at the same time, it becomes more likely that we're going to end up with a glut of data centers at some point. Each player is looking at their own supply and demand and making seemingly rational decisions to expand their capacity, but there's just not enough consideration of the total cumulative future supply. And this is the classic game theory problem that leads to industry oversupply and what we call the capital cycle in business. The capital cycle is played out tons of times across different industries like railroads, telecom, oil and gas, solar, and a ton more. And the biggest episodes of the capital cycle have had major effects on the overall economy. The dot-com bubble and bust in the 90s and early 2000s is a pretty interesting example here because the early internet infrastructure build-out peaked in 2000 at about $100 billion a year, which was roughly 1% of the $10 trillion annual US GDP at the time. And this year, the AI CapEx boom is of similar magnitude, about 1% to 2% of the $30 trillion nominal US GDP. In the bubble phase of the dot-com era, you had hundreds of unprofitable companies that went public. Big tech companies at the time like Lucent, Intel, Microsoft, Cisco, they all boomed. And then in early 2000, it became clear that dot-com companies' revenues weren't growing fast enough. There was a ton of cash burn. You throw in some tight monetary policy, and all of a sudden the market quickly lost confidence in the dot-com boom. Here you can see some summary data that I took from John Cassidy's fantastic book, .con, which is a detailed history of the dot-com boom and bust. Here you can see that within just a few months, many dot-com stocks of the day were down more than 50%. And within 2 years, more than 70% of all U.S. tech stocks had experienced devastating drawdowns, greater than 90%. Lucent, for example, went down 99% from its peak, and there were tons of bankruptcies as well. Cisco is a perfect example here of how a bubble can become a long-term overhang on a stock. From 1995 to 2000, Cisco's revenue and net income went up more than 10x. The stock mooned more than 20x, and it even became the second largest company in the S&P 500. At one point, it traded at over 100 times price to earnings. However, 2001, Cisco's revenues declined more than 20%, net income went negative, and the stock collapsed by 70%. And amazingly, Cisco actually returned to revenue and profit growth as soon as 2003, but its stock struggled for the next 15 years. Even after adjusting for dividends, it took 20 years for investors who bought at the 2000 highs to break even. Yeah. And the S&P 500 and the NASDAQ indices also experienced a 3-year bear market after the dot-com collapse, with peak-to-trough drawdowns of about 40 and 80% respectively. Oh, man. Today, tech companies are an even larger share of the major stock market indices. So even though I've said I don't think AI spending will push mega-cap tech companies into financial distress, the stock performance is a whole different question. Now, if there's one saving grace here, it's that the mega cap tech companies today are trading at lower valuations on average than the largest companies did back at the peak of the dot-com bubble. So maybe that'll help us sleep a little better at night. So it's not surprising that we're seeing a ton of worry and public criticism over the AI data center boom. Every major media outlet has run a story this year about an AI bubble. Even famous, successful investment firms like Apollo and Sequoia have been out there warning investors about an AI bubble. OpenAI's founder himself, Sam Altman, has even admitted we might be in the midst of a spending bubble. And that's hilarious, because OpenAI is moving more aggressively than any other company on data centers, committing to many gigawatts of new capacity. In fact, the unprofitable private company has made commitments for over $1 trillion of future spending. One of the major criticisms of AI is that there's never going to be enough revenue generated to justify these types of massive investments. And I'll link to a few posts that make this claim in the video description with some different assumptions. I don't agree with all the assumptions, but certainly some interesting reads. MIT poured gas on the fire earlier this year when they released a study saying that 95% of large enterprises have seen zero return on their AI deployments. So if that's true and businesses aren't generating revenue or cutting costs with AI tools, then how can this technology ever justify the investment? And yet, you have the visionary executives at the CapEx cartel, the Neoclouds, OpenAI, Oracle, NVDA, all these companies that are increasing their data center spend still in 2025 and 2026. Their words and their actions are defying the bearish narratives. So what are they saying? Let's hear from some of their comments straight from earnings calls and conferences. Google CEO Sundar Pichai recently said that the risk of underinvesting is dramatically greater than the risk of overinvesting for them, and that they expect to remain in a tight supply environment in 2026. Amazon CEO Andy Jassy said on the Q2 earnings call, it's so early right now in AI. AI is the biggest tech transformation of a lifetime, and AI is going to change every customer experience that we know. Then Oracle's Larry Ellison has said that training AI models is a multi-trillion-dollar market, and the AI inferencing market will be even larger than that. AI inferencing will run robotic factories, robotic cars, drug discovery. It'll automate legal processes and financial market trading and all these different things. And then you've got Meta's Mark Zuckerberg, who is maybe one of the most bullish on AI of all the big tech CEOs, and he said that the increased productivity from AI will make advertising a meaningfully larger share of global GDP than it is today, which would benefit Meta. And in Q3, he said, I think that it's the right strategy to aggressively front-load capacity, so that way we're prepared for the most optimistic cases like AGI. And if it takes longer, worst case scenario, they'll slow down their investments and grow into them over a few-year period where their internal businesses can use that additional capacity. Microsoft CFO Amy Hood has said that despite accelerating their data center spend in 2025, that basically they're still seeing demand improve and they expect to remain capacity constrained well into 2026. So look, clearly none of the big tech leaders are worried right now about data center supply or AI demand. If anything, they continue to tell us that there's just not enough compute to meet demand and that these use cases are going to multiply exponentially in the years ahead. And even though I personally believe that we'll eventually have too much data center capacity at some point, it certainly doesn't seem like we're really at that point or anywhere near that point yet. Let's talk about the elephant in the room, OpenAI. Their $1+ trillion of AI spending commitments is insane, but we also can't deny their success so far. OpenAI's ChatGPT reached 100 million active users faster than any independent app in history. It was the fastest of 500 million active users, and today, it has over 700 million active weekly users, which is up 4x in just a year. It's also now in the top 10 most visited websites in the world, and it was by far the fastest company to break onto that list. OpenAI currently expects its annual revenue to exceed $12 billion this year and potentially more than $100 billion annually by the end of the decade. But can it really get there? Well, for comparison, Meta has more than 3 billion active users today, does around $200 billion of annual revenue, or over $50 per user per year. And users are monetized mainly by selling ad slots to advertisers. Now, the current growth trajectory suggests that ChatGPT could probably get to a couple billion users like Meta by the end of the decade. But what about monetization? OpenAI has given its product away to most of its users, although reportedly 5% of its customers do pay for ChatGPT Pro or API access. But average annual revenue per user at ChatGPT is less than $20 a year. So today, Meta monetizes its users at more than 3x the rate of OpenAI. However, the future of OpenAI could look very different. Tech analysts believe that OpenAI is moving towards monetization paths that could include advertising or even taking cuts of e-commerce transactions. And several signs point to this, including OpenAI's recent partnership announcements with companies like Shopify, Etsy, Booking.com. And it's been reported that ChatGPT is already a major source of referral traffic for major retailer websites like Walmart.com. So it's not crazy to think that they could start taking a cut of transactions where a user is asking for a product recommendation or a travel itinerary, for example. And then there's the possibility that ChatGPT could be integrated into things like phones or cars, smart glasses, robots. I mean, it's certainly possible that OpenAI could go from deeply unprofitable to one of the most profitable companies in the world. However, the path to get there is still pretty uncertain given the $1 trillion+ of spending commitments and also the competition. And speaking of the competition, there are other major LLMs out there, including Google's Gemini, Anthropic's Claude, xAI's Grok, DeepSeek, Alibaba's Quinn, Meta's Llama, and Mistral, and they're gaining traction. So as we expand our view to the overall industry, the revenue pie does expand quite a bit, which is good for AI as a whole. Anthropic, for example, projects it could be at a $9 billion annual revenue run rate by the end of this year, and they hope to triple that by next year. Google Cloud's business will add over $10 billion of revenue this year at a more than 30% growth rate, which is driven heavily by their AI enhancements. Azure, AWS, and Oracle also accelerating and growing their cloud businesses significantly on the back of AI usage and features. And then there are a lot of AI startups that are building their companies on the platforms and generating revenues, including ones you've probably heard of like Cursor and Lovable, N8N, 11 Labs, Runway, HeyGen, Perplexity, and a bunch of others. Then you've got existing software companies that are also building in AI features like Adobe and Salesforce, and even younger upstarts like Canva and Notion. So if you add it all up, I estimate that the industry will generate close to $100 billion of revenue this year from AI products across things like LLMs, the clouds, the Neoclouds, software companies, software features, new startups, and we're still in the early phases of monetization of AI. Future revenues are going to be generated by devices like smart glasses and robots, AI phones, autonomous vehicles, and new software features, even e-commerce transactions. And that doesn't factor in potentially huge cost reductions for some businesses from replacing some of their labor with LLMs. So in my opinion, MIT's study is the equivalent of someone saying in 95 that retailers aren't doing a lot of online revenue. It's like, duh. We're only now just beginning to see the very first glimpses of how AI is going to be deployed in large enterprises. They're still figuring it out. Now, job displacement, it's a scary proposition to a lot of people, right? But my hope is that new jobs will get created just like in every other major tech boom of the past. So think about it. A decade ago, we didn't have social media managers, UX designers, YouTube streamers, Uber drivers, for example. In the short run, I do worry the next recession could be harder to recover from if a lot of companies attempt to cut headcount and do more with AI. Perhaps that's a topic for a future video. But long term, I still remain very, very optimistic. One key problem in trying to figure out if AI is a bubble or not is that the data center CapEx spend happens up front, while the revenues that they generate can take years to ramp. So, in other words, we have a timing mismatch. And the other problem we've got is that there are several different business models in the mix here to analyze. Like the profitability of a Neocloud may look very different from Meta, which is going to look very different from a startup that rents GPUs rather than building data centers. So anyone screaming AI bubble should be clear about what part of the ecosystem they think is going to fail and why. But let's focus on the data center owners here for a minute. I created this simplified spreadsheet to help us understand how much revenue and profit is needed to generate a given return on an AI data center. And my inputs are triangulated from sources like Neocloud financials, public company disclosures, and industry publications like SemiAnalysis. On the left side here, you can see how a 1 gigawatt data center's CapEx breaks down into major categories like land and buildings, power transmission equipment, GPUs, servers, cooling, networking. A 1 gigawatt data center can cost north of $25 billion and as much as $50 billion depending on location and complexity. I'm using a $40 million per megawatt figure or $40 billion per gigawatt data center. And roughly 15 to 20% of that value will get depreciated on an owner's income statement each year using my estimates. Now, on the right side, we start with a target return on invested capital, and most project owners will want to earn something in excess of the return you could get on a liquid corporate bond. A 9% ROIC that I've used here would do that, even though it's not a terribly high return hurdle, but it does translate to a respectable 15% plus annual return for equity holders in a project that is 80% debt financed and 20% equity financed. So if we take the roughly $500 billion spent this year on AI data center capacity globally, a 9% ROIC means the industry needs to generate $45 billion of incremental net operating profit after tax, or NOPAT. And using a 25% tax rate, that translates to incremental operating profit before tax of $60 billion, or EBITDA of $145 billion once we add back depreciation. And using the EBITDA margins of CoreWeave, which is probably the most pure play AI data center operator we have that's public, it implies the industry needs to generate around $240 billion of incremental top line recurring revenue just to cover its 2025 AI data center buildouts. So if we assumed a 0% required return, the industry would still need to generate $140 billion of revenue and $85 billion of EBITDA just to cover annual depreciation expense. I said earlier, I think the industry is probably generating somewhere in the neighborhood of $100 billion of AI revenue this year, and that's growing at a rapid rate. And maybe it doubles or triples next year. And if so, the industry would actually be pretty close to earning an okay return on its 2025 CapEx. However, we also know that data center CapEx outlays will be even larger in 2026 based on what the CapEx cartel has said on recent earnings calls, and there will likely be between 10 to 20 gigawatts of additional global AI data center capacity built in 2026. So that just raises the required revenue bar by another 300 to 400 billion, which is the equivalent of adding the combined current revenue of AWS, Azure, and Google Cloud. So look, that level of additional revenue requires a step function change in monetization across all major AI players, AI startups, and traditional software businesses. And I mentioned there are many possible sources of new revenue, but if the revenue sources are slow to ramp, then we will almost certainly end up with too much data center capacity and low returns on this capital spending. And thankfully, there are some rate-limiting factors on how fast AI data centers can be built, things like multi-month backlogs on electrical transformers, regulatory delays from the grid operators, and of course, TSMC's leading-edge wafer production capacity, which determines how much NVIDIA can produce. But no matter what, you have to believe in some very aggressive future revenue scenarios for AI investors to completely avoid some pain along the way here. And that brings me to the investing implications of the AI boom. And there are hundreds of publicly traded stocks that have benefited from the AI boom just in the past 3 years. Here you can see the blistering performance of just a small subset of those stocks. You've got the semiconductor hardware companies like NVIDIA, Broadcom, AMD, Micron. You've got the electrical equipment providers like Eaton, GE Vernova, and Quanta. You've got utilities like Vistra and Constellation, the Neoclouds, CoreWeave, and Nebius, Bitcoin miners turned data center operators like Iron and Core Scientific, and then, of course, the mega cap tech companies. But look, if the world finds itself with too much AI data center capacity later this decade, some of these companies are going to fare much worse than others. So which ones have the best risk versus reward right now? Well, here's my attempt at ranking some of the companies in the AI boom into tiers. Now, keep in mind a couple of caveats here. I'm weighting valuation almost as much as business quality and opportunity. 2, my opinions are going to evolve as the facts on the ground evolve in the next couple of years. And 3, this isn't financial advice. You got to make your own stock investing decisions. But let me walk you through some of my own thoughts here. Now, at the bottom of the list in the D tier, we have what I would consider the extremely speculative secondary AI plays, and a lot of these already trade at sky-high valuations. For example, Oklo, the small modular nuclear reactor company that wants to build a bunch of microreactors to power AI factories, well, it's got a $15 billion plus valuation already, despite not even having built out its first unit. So best case scenario, they get some stuff built by the end of this decade, maybe, but what is the data center power market going to look like then? And what will the economics be of the SMRs? No one really knows. And investors are still giving it a lot of credit right now. Historically, though, power utilities and equipment providers have not traded at high valuations, even when they have stable revenue and earnings. So I think Oklo I would put in that D tier for sure. I also have the AI pretenders like C3.ai, which despite having AI in its name and having the AI ticker, it's seen its revenue shrink in 2025 during the greatest AI boom of our lifetimes, right? Something's not right there. And then you've got Supermicro, which also finds itself in the D tier because of accounting issues and very, very low gross margins. They just can't seem to make money here in the AI boom. And then one step above those companies, you got the C tier, and that includes power utilities and Neoclouds, which are experiencing fast growth. But in my opinion, these have the most significant risk of a major drawdown if the data center boom starts to slow. CoreWeave, it's probably going to surprise on the upside on revenue growth in the next 1 to 2 years. They're going to have explosive revenue growth, but I do worry long term that they're going to be the marginal provider of AI compute, and they're going to see GPU pricing pressure eventually, and maybe even utilization issues later down the line. So this is more of an issue with the business model longer term. That would also apply to Nebius, by the way. And this also applies to the crypto miners turned data center operators who, in my view, don't have a ton of existing value add besides the power contracts that they've got. And I would also put some of the utilities in this bucket, mainly because utilities have typically traded at low valuation multiples. Today, though, they trade at higher valuations than average, and they also carry risk of regulatory backlash, pricing controls, disaster risk like wildfires and grid failures. But, maybe something like the XLU, a diversified basket of utilities, could make some sense in a portfolio, because they are going to see some growth from the demand and the explosion in AI data centers being built. Now, then one step up, we've got the B tier, and this is where you'll find a lot of companies in the AI boom. Oracle, for example, massive backlog of revenue and potential for earnings growth, but it does have some single customer risk with unprofitable OpenAI making up most of that revenue backlog. And Oracle also has much less cash flow than, say, the CapEx cartel, which, is going to be hard to fund the many billions of needed infrastructure build-out that they're planning to do. And Oracle's already turning to the debt markets to help fund that build-out, which adds some long-term risk. So Oracle may be a decent investment, but it's certainly got some risk. Funny enough, I also put Meta in the B tier because they are the most aggressive in ramping both expenses and CapEx for AI, which could weigh down its cash flow generation potential for years to come. It also doesn't really have an external cloud business to help generate revenues that can feed the data centers. And so it needs to generate a lot more ad revenue in the future and a lot more things like AI glass revenue to justify the spending. Now, Meta is growing really, really nicely. They have great performance, but I think investors could become impatient with Meta's spending ramp that we're seeing now and into 2026, just like they did back in 2022. Now, Meta may also have some of the highest eventual upside from AI, but I think the potential outcomes are pretty wide with Meta. That's why I put it in B tier. Then you've got Amazon, which has the largest cloud infrastructure business in the world with AWS, and that means that AI workloads are going to be a big growth opportunity. But again, Amazon also has the most to lose in terms of market share to newer players like Oracle and the Neoclouds. And AWS did re-accelerate growth recently, and they also signed a $38 billion deal with OpenAI, so things look okay for now for Amazon. Outside of AWS, though, most of the AI benefits for Amazon are probably going to be things like cost-saving opportunities in the retail business, and they do have investments in outside companies like Anthropic, which could do well. Maybe the dark horse here for Amazon is that an improved Alexa might have a shot at becoming a much more useful AI assistant that drives more retail revenue. But for now, I'm kind of cautiously optimistic about Amazon. I place it in the B tier. And then you've got Apple, which has disappointed users with its AI implementation so far. They can't seem to retain their AI talent within the company very well. And AI glasses also pose a threat to mobile phone revenues over the long term. However, Apple could also buy or license some of the best LLMs out there for its existing phones and devices and sidestep all the CapEx spend that the other companies like the CapEx cartel are funding. So Apple is kind of taking the CapEx light approach right now, and it may pay off. And Apple's large existing user base still gives it a strong position from which to implement AI features in the future. So if they can get it together, they've still got a lot of opportunity here. Then you've got Microsoft. It's got a collection of great businesses, and they're accelerating Azure cloud growth, and they can benefit from a lot of features of AI in their own software. They also own a major stake in OpenAI, and they seem poised to take pretty strong advantage of AI overall. But they're also pretty heavouly committed to data center buildouts and huge contracts with Neoclouds through the end of the decade. So for me, it's probably a hold, but I'd want a bigger correction, maybe a little bit more margin of safety, and I could see adding to the position. Then you've got memory players like Micron, which I bought as low as the 60s in the spring of 2025 when we had the correction, and this year it has soared since on rising demand for high bandwidth memory. Now, demand for memory vastly exceeds supply right now and probably well into 2026, and that bodes very well for pricing on memory and earnings for Micron. However, memory is a cyclical industry, and we've got a lot of previous examples of overbuilding capacity in this industry, and I've seen memory prices plummet in a hurry. So as valuation rises on these memory stocks like Micron, I naturally find them less attractive because they are so cyclical. So I've been slowly scaling out profits on the way up on my Micron position, reducing position size. I still hold some, but I'll continue to do that if it continues to rise. And if this cycle ends up being more prolonged than previous memory cycles, then so be it. I'm okay with missing out on some of that upside. Then you got Tesla. Tesla's the ultimate bull versus bear battleground stock. You've got the existing EV business that's been suffering from lower sales and lower margins this year, yet Tesla still sports a $1.4 trillion market cap and the highest price to earnings multiple in all of the Mag 7. And this high valuation persists because of the promise of future earnings potential from things like autonomous cars and humanoid robots. And these future markets have multi-trillion-dollar potential. But there's a ton of execution and competition risk ahead for Tesla that people sometimes just gloss over. The market is already giving Tesla a lot of credit, despite missed deadlines on certain things like AVs, and a lot of unfulfilled promises, Roadster, semi-truck. But, it's going to be very interesting. In AVs, Tesla has a shot to be a very, very dominant player, but we're already seeing Waymo start to scale out. In my home market of Austin, for instance, I've been able to take many, many Waymo driverless rides, but the Tesla robotaxi network is still getting booted up. They're still using safety drivers. So it's very unclear at what point Tesla really starts to push hard. And I do think they will make quick progress with robotaxis, but it's still going to face competition from Waymo. It's still going to face regulatory hurdles. And they've also got significant competition in the humanoid robot market as well. You've got well-funded private companies like Figure, Agility, Unitree, Apptronic, XPeng. Personally, I remain a little bit more of a skeptic on Tesla stock than some others until I see the execution improve or valuation get a lot cheaper. And Elon does have a comp package which incentivizes him to hit very aggressive targets. So it's going to be very, very interesting to see where Tesla goes here in the next few years. Now, other B-tier players, in my opinion, would be diversified electrical and equipment providers like Eaton and GE Vernova. And these companies are enjoying a growth acceleration from data center buildouts, supplying equipment like gas turbines and transmission equipment. But there's eventual risk from a slowdown. The good thing for them is they're not totally dependent on AI demand, and valuations are higher than their historical averages, but they're not outrageous. So given their backlogs and the fact that earnings are likely to grow, they're probably going to still do fairly well, but I do think they have some risk down the line as things slow down in the AI build-out, maybe later in the decade. Now, then you have the A tier, Google. It was the laughing stock of AI after its Bard release just a couple of years ago, and now recently it's taken the world by storm with some of its recent models like Gemini 3, Nano Banana, Veo, and Google Cloud is also growing faster due to AI deployments. Then you've got Google's consumer products like Gmail, YouTube, and Search all implementing AI features and benefiting from these awesome AI features that Google has developed. And while LLMs remain a threat to Google's core search monopoly, it seems like Google's defense of that moat is much stronger than it was even a year or two ago. Android is also a great major asset and distribution advantage for Google because they can deploy their AI software into hundreds of millions of devices. And the icing on the cake is Waymo, which, as I mentioned, is scaling rapidly now into many cities and has surged into what many would consider to be the lead in self-driving cars. And also, Google's stock valuation remains pretty reasonable, although it has gone up quite a bit, a couple of multiple points recently, but it's still around 30 times earnings. Then you've got NVIDIA. I'm not going to spend too much time on NVIDIA here. It's been the most obvious winner of the AI boom so far. And unlike Cisco back in the dot-com bubble, NVIDIA's valuation has remained in pretty reasonable territory, even as revenues and profits have surged. And that being said, though, NVIDIA, as it's grown larger, revenue growth is naturally decelerating a bit. It's still growing pretty fast, but it keeps decelerating each quarter. And if we go through a period where companies decide to pull back on AI CapEx spending or optimize their GPU fleets, NVIDIA could see some growth headwinds at some point. Maybe this a later in the decade type of event. But long term, there still are plenty of opportunities for NVIDIA to grow with hardware upgrades. They've got Rubin coming out next year. You've got robotics and autonomous cars, which will need GPUs, and numerous other end markets. For me, it's personally hard to get excited about, the largest market cap company in the world, and knowing that there's probably going to be a reckoning in data center spending at some point. But that being said, I'd get interested in NVIDIA again with a big enough correction. And it's obviously been a huge winner in AI and will probably continue to be for the near term. Now, then we move up to the S tier. And alone in the S tier, in my opinion, is TSMC. In my opinion, this semi manufacturer is the most important company in the world. It supports all of the leading edge hardware powering the AI boom, including NVIDIA GPUs and many others as well. And they remain on the bleeding edge of scientific breakthroughs in semiconductor manufacturing. And basically, without them, the computing industry would not exist in its current form. And TSMC's net income has grown fivefold in the last decade and should continue to grow long term as demand for compute grows across multiple end markets. And despite a $1.1 trillion market cap, the stock's valuation is below that of the S&P 500, trading at just 20 times earnings. And while some investors worry about China invading Taiwan and taking over TSMC's fabs, They are building more fabs outside of Taiwan to diversify. And not to mention the fact that the rest of the tech sector would probably collapse if TSMC fell to China. So in my view, buying any other large cap tech stock carries the same Taiwan risk as TSMC, basically. TSMC is a uniquely compelling asset that just basically cannot be replicated and should probably trade at a premium valuation to everything else, but right now it doesn't. So I own some. I bought some in the recent correction, and I'll continue to own it. And that's my plan there, and that's my view. Now, many of the companies mentioned in my tier list here are benefiting from the first wave of the AI boom, the infrastructure build-out, and many of their stocks have already priced in a pretty bright future. But ultimately, I think most of the long-term value from AI is going to be generated downstream by the companies providing AI applications and software to consumers and businesses. You know, in the dot-com boom, the early winners might have been infrastructure plays like Intel, Cisco, and Lucent, but the real long-term winners were companies like Amazon, Booking, Facebook, Salesforce, Uber. So I see opportunity in shifting focus to the companies that could start generating huge revenue growth by implementing the best AI features in the future. Now, sadly, many of the most exciting companies like Cursor, 11 Labs, HeyGen, N8N, Descript, Suno, a lot of those are not yet public. But there are some existing public companies out there which are being underestimated, in my opinion, even seen as AI losers in some cases, despite huge potential for future growth from AI features. So I've been taking a close look at companies like Atlassian, HubSpot, Five9, UiPath, Adobe, Duolingo, and others. And I'm just starting to develop my thesis around a couple of these, and I've got small positions in 2 of them right now. I'll be sharing more of my thoughts on these AI application companies in the future. So what are our takeaways here? What is the TLDR? Number 1, I do think an AI bubble is inevitable. I think we're going to end up with too much data center capacity at some point. But right now, compute demand is still rising faster than supply, so we could be years away from the reckoning. So don't drive yourself crazy or broke trying to call the bubble top. After all, being way too early in investing can be as expensive as being wrong. Number 2, most of the Magnificent 7 stocks, I think they're going to be able to survive the inevitable fallout just fine, given their immense cash flows and their ability to readjust CapEx. And for most of the big players, I expect the eventual hangover is going to look a lot more like the 2022 correction than the 2000 bust. Number 3, unproven concept stocks like SMRs, the Neoclouds, and players that are solely dependent on AI infrastructure buildouts to drive their growth, those are going to carry the most long-term risk in my opinion. And number 4, there's still tremendous value to be generated in AI applications. We've barely just scratched the surface there. So if too much computing capacity is ultimately built, well, that's just going to drive down costs and benefit the AI app developers the most. There's going to be plenty of long-term stock value generated in the aftermath of an infrastructure boom and bust. So have no fear. And as always, I'll be here with plenty of ideas and analysis along the way to help you make sense of it all. And speaking of ideas, I've got a few new stock positions in the portfolio and a portfolio update video coming soon on the channel, so be sure to subscribe if you haven't already. And I'll see you soon, my friends. Cheers!